Hi. Today we are revising introduction of partnership. Along with that, we are also revising admission of partnership. Okay. So I will quickly take you through the concepts. So first I will explain you what is the meaning of partnership. That is, as per the section 4 of the Partnership Act 1932, partnership is the relationship. So partnership is the relationship between the persons. So between the persons, it's a not a person, persons, which means there must be two or more, right? Two or more who have agreed to share the profits of the business. So who have the relationship between the persons who have agreed to share the profits. That doesn't mean that partnership is always profit one. No, there might be loss also, but profit includes loss. Okay, agreed to share the profit of the business carried on by all. That is, everyone can work towards that business, or any some of them working for that business. Okay, the other all will act like that, just investors. Okay. So what are the features? Partnership comes into existence by an agreement. So agreement, whether it should be in written, sir, or whether it can be in oral. It can be in written or oral. No hard and fast rule. Okay. So agreement of partnership can be in written form or it can be a oral one. You might have already learnt it in your Indian Contract Act, right? Contract can be oral as well as written. Okay. So agreement might be a written formal agreement or a oral agreement. Okay. If it's a written formal agreement and it is registered, we call it as a partnership deed. Okay, we call it as a partnership deed. Having a partnership deed in the business has its own advantages. What are those advantages? We will see. So what are the kind of businesses partnership can enter into? They can enter into any legal business. It might be trade, it might be profession, occupation, anything in partnership. You can enter into any business until it's a legal. Okay, and to be a partner in a partnership, existence of business is very important. Partnership means there should be a business. Okay. Next one is sharing of profit. All the partners are entitled to the share of profit. You cannot deny profit to anyone. All the partners who are in the business are entitled for the profit. Okay. But whether everyone is entitled to the loss? Not necessarily. You can say that certain partners are need not to share the loss. Certain partners are need not to share the loss. Just like our minor. A minor can be a partner in the organization, I mean firm, provided that he will be only partner for the profit. If there is any loss, he cannot bear it. He will not bear it also. Okay. Otherwise, they will bring some 13-14 years kid and they will start cheating them. Right. So, next one is mutual agency. One partner's action in the name of the partnership firm will bind the other. One partner's action in the name of partnership will bind the other partners also. So everyone is principal of everyone and agent of everyone. Okay. Next one is minor of a partner. Yes, minor as a partner. Yes, minor can be a partner provided that he should be only partner for profit. Okay. Partnership deed. What do you mean by partnership deed, sir? Partnership deed is a written legal document that contains an agreement made between the partners. So written legal document. I repeat, written legal document. Partnership deed cannot be a oral. It is also called as partnership agreement. Okay. What are the clauses will be there in the partnership deed? Name of the firm will be there. Name of the partners will be there. When we commence the business will be there. Till when we are going to take this business will be there. How much capital is introduced by each partner will be there. How much drawings will be allowed to each partner will be there, and how many months once he can take, all those things will be there. Interest will be there. How much will be the interest charged on the capital, how much will be the interest charged on the drawings, how much is the interest on the partner's loan, etc. The ratio in which those partners are going to share the profit and loss, that will be there. If there is any variation in the duties of the partner, that will be there. For example, if you are having 10 partners, you might give 2 partners right to sign, right? So right to sign the checks, of the bank on behalf of the firm. So all those things will be there. Who are those partner, all those things. You can go through it once. What if partnership deed is not there? What if partnership deed is not there? From the firm point of view, firm cannot sue any other one. Firm cannot sue other firms, other parties. But other parties can sue our firm, which means they can file a case against us, our firm, where it is not registered. But we cannot file a case against them. Okay. What if there is an absence of partnership deed, sir? What if the partnership deed is not there? When the partnership deed is not there, partner are not entitled for any salary or a remuneration. Partner are not entitled for any interest on capital. Partner, we are not going to recover any interest on drawings. If the partner has given any loan, 6% is the interest per annum which we are going to pay to him, and profit and losses will be shared equally among all the partners. Okay. One more thing. Although agreement allows, all these items are there, no, except that interest of 6% per annum, they are appropriation of profit, which means only profit is available, then only it will be given. If there is a loss, it cannot be given. Okay. Accounting for partnership, you can say expenses divided into two, charge against the profit and appropriation of profit. If it's a charge against profit, what do you mean by that, sir? It should be paid irrespective of profit or loss. Whether organization is making profit or organization is making loss, that doesn't matter. You have to pay certain expenditures. Okay. Whereas appropriation of profit means it will be the portion of the profit which is kept aside, will be given as some other terms, right? Dividend, salary to your partner, all those things. Okay, that should be given only if there is a profit. That is usage of the profit. Appropriation of profit means usage of the profit. So that usage, to show that usage, we will prepare one account called profit and loss appropriation account. To show that usage, we are going to prepare one account called profit and loss appropriation account. You can see the format. Net profit we will bring from them. Later, whenever we want to give something to our partners, we will credit their account, right? Because their capital balance will get increased. So debit the P&L appropriation account. For example, interest on capital, salary, commission, etc., etc. When we want to recover from our partner, we are going to debit their account to revaluation, P&L appropriation account. So what will be the entry? Partners capital account debit to P&L appropriation account. For example, it's a interest on drawings. Later, whatever remains will be shared among the partners in their profit sharing ratio. Okay. What are the methods of maintaining the capital? Capital can be maintained in fixed method as well as fluctuating method. If it's a fixed method, two accounts are opened. Which are two accounts, sir? One is capital account, one is current account. Whereas if it's a fluctuation method, only one account is opened, that is capital account. Okay, sir, done. Okay. How we are going to treat it? In a fixed method, in the capital account, only three things will be recorded. In the fixed method, capital account, only three things. Initial capital introduced, additional capital introduced, permanent withdrawal. Initial capital introduced, additional capital introduced, permanent withdrawal. Okay. And whatever happens to the partner's capital account other than these three, everything will be recorded in the partner's current account. Everything will be recorded in the partner's current account. So partner's capital account will always show credit balance or zero. Partner's capital account will always show credit balance or zero, but current account you never know. It might show debit balance as well as credit balance. It can show debit balance or credit balance. Okay. So current account might show debit or credit, whereas partner's capital will show only credit. Okay. What if it's a fluctuating method? It is nothing but merger of current account as well as capital account. Whatever is affecting the partner's capital account, everything will be dumped into this particular account. Okay, sir, fine. If there is a net loss, what I told already, partner's salary, partner's commission, partner's interest on capital cannot be paid when there is a loss, because these are the appropriation of profit. Appropriation of profit means these can be paid only if the profit is available in the business. Okay, sir, done. What if there is a insufficient profit? What if there is a insufficient profit? When there is insufficient profit as well as interest on a capital to be provided, insufficient profit as well as interest on capital to be provided, what we should do is, the profit will be available, no, insufficient profit. For example, interest on capital is 10,000. Your profit is only 7,000. Now, what you have to do is, 7,000 is there, no, that you are going to divide it in the capital ratio. Other than that, if it's a sufficient profit, then we will give a interest on capital, whatever remains, that we are going to share it in their profit sharing ratio. But where there is a insufficient profit and where there is a interest on capital, then what we can do, sir, we can give it in their capital ratio. Give it in their capital ratio. Okay. Next one is guarantee of minimum profit. Here what happens is, we will ask someone to be in our business and we will tell them, boss, we are going to pay you the minimum profit. If you make loss also, we are going to pay. Okay. So much is your minimum profit. So your profit from the business is your minimum profit or actual profit, whichever is higher. Whichever is higher. So minimum profit who has to bear, sir? If there is a loss, you have to pay someone, no? Who has to bear? Depending upon the agreement. There might be one, all the partners might share, some partners in some ratio, or only one partner might share, all those things. Okay. Now we are starting with the admission. What do you mean by admission, sir? What do you mean by admission? Admission is nothing but taking a new partner into the firm. Taking the new partner or partners into the firm. Okay. Adding one more partner or partners into the existing firm. Okay, sir, done. But is there any restriction on number of partners, maximum partners? Yes. As per the Partnership Act, you have to look at whether it's a banking or non-banking. If it's a banking, then maximum 10 partners. If it's a non-banking, maximum 20 partners. If it's a Companies Act, then maximum 50 partners. In all the acts, minimum partners are 2. In all the act, minimum partners are 2. Okay, sir, done. Next, why we are going to admit a new partner into a business? Why are we going to admit new partner into the business? One, we might be in the need of money. Okay, so we can't take loan because we have to pay interest. So we will ask some other guy, we are going to give you your profit portion, so give us a capital. Or we might be bringing new partner for a managerial managerial efficiency, to improve the managerial efficiency, for technical reasons might be, to continue the partnership, because 2 persons are there, one partner is planning to retire. Then if he retires, the firm will come to end, right? So what we will do, before he retires, we are going to admit a new partner. That could be the one. So there are so many reasons why the new partner is admitted. Okay, sir, whether Partnership Act 1932 allows a new partner to be admitted? Yes, it allows, and it says, unless something is told in the agreement, all the partners' consent is required. That's it. If all the partners agrees, okay boss, we can admit this person as a new partner, then they can admit. Provided that if agreement says all partner is not required, out of 10 partner only 6 partner are enough, I mean 60% of partners agrees for that, you can admit, then yes, 6 partners are enough. If there is nothing in the agreement, then all the partners should agree. Okay. When the new partner comes into business, from the accounting point of view, what are the things going to change? 1. Computation of a new profit sharing ratio is what you are going to do. 2. Along with new profit sharing ratio, of course, you are going to find out a sacrifice ratio. 2. Revaluation of assets and liability. 3. Distribution of reserves, accumulated profit and losses. 4. Adjustment for goodwill. 5. Adjustment regarding capital contribution of new partner and capitals of the existing partners. 6. Adjustment for life policy. Okay. First one we will go now. Computation of a new profit. What do you mean by new profit sharing ratio, sir? New profit sharing ratio is the ratio in which all the partners will share the future profit after admission of a partner. I repeat, new profit sharing ratio is the ratio in which all partners will share the profit of the business after reconstitution of the partnership. Okay. Fine, sir. How to arrive at a new ratio? New ratio is nothing but a old ratio minus sacrifice ratio. New ratio of a existing partner is old ratio of existing partner minus sacrifice ratio. Okay sir, what do you mean by old ratio? Old ratio is the ratio in which old partners used to share their profit or losses before the admission of a new partner. Old ratio is the ratio in which the old partners used to share their profit or losses of the business before the admission of a new partner. Okay sir, done. Next is what do you mean by sacrifice ratio? When the new partner comes, for example, you are having a pizza of 8 slices. Now you are 2. Now one guy comes. So for him, when you have to pay the when you want to give the slice of pizza, yours will get decreased. No, your portion will get decreased. Otherwise, you used to have 4. But now that guy came. You gave 1. The other person gave 1. Now you are having 3 slices. One slice which you left. No, that is called as sacrifice. So sacrifice ratio is the ratio in which existing partners sacrifice their future share of profit to the newly admitted partner. Okay, one is that. Okay. Second one is revaluation of asset and liability. Listen very carefully. We know that we have one concept, no, cost concept. We know one concept, cost concept. Usually we will record our balance sheet as per cost concept. Sometimes what happens, our value of the asset is more than cost, but still we are recording it at cost because of conservatism concept, right? So because of that conservatism concept, we might be recording it at cost, but the thing is market value might be less or more. Now tell me, who are the partners who are responsible for that increase or decrease in the value of asset or liability? Who are responsible for that? Whether the new partner or existing partner? Of course existing partner, because new partner haven't joined the organization yet, haven't joined the firm yet. So whatever happened in the firm, in the increase or decrease in the asset and liabilities, that will be of the existing partners. So what we will do, when the new partner comes, if we do not revalue our asset and liability, at the end even our new partner will get a share for such increase or decrease, which is basically unfair because he hasn't worked towards it. Only existing partner worked towards it. So what we will do is, we will find revaluation loss or profit, and we will, if it's a revaluation loss, we will charge it to the existing partners because those are the people who made it. And if it's a profit, revaluation gain, we are going to credit it to the existing partners because it is their efforts. Okay. So what we will do is, we are going to revalue our asset and liabilities at the time of admission. Okay. It looks like this. When we do the revaluation, if there is an increase in the asset, of course we have to debit the asset, no? So debit the asset, credit the revaluation account. Okay. So what will be the entry? Asset account debit to revaluation account. So in the revaluation account, it is by asset account. Let us assume increase in the liability. Increase in the liability means, of course it's a credit, no? So what we should do? Revaluation account debit to increase in the liability account, or to liability account brackets increase. Okay. Decrease in the asset. When the asset is decreasing, what we should do? We should credit it, no? So what will be the entry? Revaluation account debit to asset account. Whereas when the decrease in the liability, it is as good as it is, you are gaining from it. Your liability is getting decreased. Decrease in the liability, what you should do, sir? You should debit it, right? So what will be the entry? Liability account debit to revaluation account. Liability account debit to revaluation account. Later we might pay certain expenses, right? For the revaluation, entry will be revaluation account debit to bank account. Okay. If our partners pays for it, then revaluation account debit to partners capital account. And later at the end, either it might be loss on revaluation or gain on revaluation. It will be shared by our partners, existing partners, in their old profit sharing ratio. Okay. Now the question comes, sir, don't you think it's unfair? Or don't you think we are just ignoring the cost concept? So let's do one thing. Let's not change it. Let's not change the value of our asset. Let it be at the cost only. So at that point of what you are going to do is, you are going to open a memorandum revaluation account. in which what he will do is, first he will do as per the revaluation. He will give a share of profit or loss to the existing partners in their old profit sharing ratio. Later, whatever you have debited, no, you are going to credit it, because if you keep it in debit, the balance will increase or balance will decrease depending upon asset and liability respectively. So what we will do, give the ulta effect. When we give the ulta effect, what happens? Debit credit gone. Same way, whatever there is in credit, we are going to debit it. At the end, same you will get. No, if there you got a profit, now you will get a loss. If there you got a loss, now you are getting a profit. Okay, that thing shall be shared by all the partners in their new profit sharing ratio. All the partners in their new profit sharing ratio, because we are keeping our asset and liabilities as it is. No, don't you think our new partner is also entitled for that now? To be an entitled one, he has to bring the money if it's a profit. If it's a loss, he has to recover the money, because in future he is going to bear the loss because of these two people, I mean existing partners. So we will pass ulta. Later we are going to share it to the all the partners in their new profit sharing ratio. You can see here memorandum revaluation like this. Later whatever increased, ulta, whatever credited will be bought here, whatever debited will be gone there, and the balance shall be paid by the, balance shall be recovered or given credit to the all partners in their new profit sharing ratio. Okay sir. Next is distribution of reserves, accumulated profit and loss. Listen very carefully. What are reserves? What are reserves? Sir, reserves are nothing but accumulated profit, appropriated profit. In the previous year, our partners were entitled to take 1 lakh rupees profit. Let us assume, let's say 1 lakh rupees. But what they did, 20,000 they kept it as a reserve, or they kept it in the P&L account only, and they bought that balance. Now, whether the new partner is entitled for that? Never, only old partner. So at the time of admission, what we will do is, we are going to give credit completely to our existing partners. In case of it's a loss, accumulated loss, then we are going to debit it to our old partners capital account in their old profit sharing ratio, because that is their profit only. They haven't taken it out of the business, that's it. So when new partner comes, if we don't take it, he is also entitled for that, whereas he didn't block his profit only. Okay, so what will be the entry? Reserve will be showing credit balance. So reserve account debit to partners capital account. Which partner? Old partner. Which ratio? Old ratio. Okay sir, done. And sir, what if they decide reserves should not be shown in reserves should be shown in the books? After the admission also they want to show the reserves in the books. Same as memorandum revaluation you have to do. First, reserve account debit to old partners capital account in their old ratio. Later, reserve now you have to credit, but here you have to give it to all the partners. You have to recover from all the partners. What will be the entry? All the partners capital account debit in their new profit sharing ratio to reserves. First give it to the old partners, later recover it from the new all the partners. Okay sir, done. Next one is goodwill. Very important concept of the partnership, which is goodwill. Sir, what do you mean by goodwill? Goodwill is nothing but the money which you are going to pay as a premium. It is a super profit. Goodwill is nothing but accumulated money of your super profit of a future years. You can say 3-4 years you are going to get more money than your competitors, more profit than your competitors. That is super profit. When you earn more profit than your competitors, that is called as super profit. Competitors in the sense everything being same. He also invested 10 lakh, I also invested 10 lakh. But I am earning 20,000 rupees, he is earning 18,000 rupees. Now 2,000 is the super profit. Super profit will be coming because of give me a second. Yeah, I have muted it, sir. Okay, sorry. So super profit is coming because of goodwill. Super profit you are going to earn because of the goodwill. Now when the new partner comes, what he is going to do in future, he is going to share the profit. Yes sir, in future he is going to share the profit. For him the old partner should sacrifice their future profit. Yes, but they had a super profit which was in their name in the future years. Yes, but now they are sacrificing. Yes, don't you think for that they will take a premium? Yes, they will take the premium in the form of goodwill. So goodwill account will come, sir? No. As per the AS 26, goodwill, you cannot show goodwill in your books unless it is purchased. If you have purchased goodwill, then you can show. Otherwise, you cannot show goodwill in your books asset side. Okay. So what we will do is as goodwill portion shall be recovered by whom? Recovered by our sacrificing partners. From whom? From the gaining partner. We will debit the gaining partner's capital account for the portion of goodwill he is going to get. That is gaining partner's capital account debit to sacrificing partner. It might be in the case of retirement, it might be in the case of death, it might be in the case of admission. Goodwill entry is same. When our partner brings the money, entry will be cash account debit to new partner's capital account. Later, he has to give certain money towards a goodwill, no? Then it will be gaining partner's capital account debit to sacrificing partners. Which ratio? Sacrifice ratio. Don't take old profit sharing ratio, take it as a sacrifice ratio. Okay sir, fine. Actually you can do it like this also. Bank account debit to new partner's capital account to sacrificing partner's capital account for the portion of goodwill. Or else you can completely transfer everything to the new partner and later debit the new partner, credit the sacrificing partner. That also could be done. Same like what if we do not bring it in bank or cash that moment. Okay, valuation of goodwill, there are basically four methods. First method is average profit method. Average profit method, what we are going to do is we are going to find out the average profit of certain years and multiply it with number of years of purchase. What is number of years of purchase? For how long, for how many more years you can maintain this goodwill, that is number of years of purchase. So what is the value of goodwill under average profit method? Under the average profit method, the value of goodwill is average profit into number of years of purchase. Average maintainable profit. Sir, what do you mean by maintainable profit, sir? These are the profit which are earned in the day-to-day transaction of the business. Some extraordinary items will not be there. Every extraordinary items will be ignored. Okay, exceptional item, extraordinary item, abnormal loss, abnormal gain, ignore it. Only ordinary transaction. You have to find out a profit through ordinary transactions and later using that you have to find out the average. Sir, which should we use, sir? Simple average should we use or weighted average you should use? If there is any trend in the profit, you should use weighted average. If there is no trend in the profit, then you can use simple average. Okay, if there is an increasing trend or decreasing trend, use the weighted average. If there is no trend, once increase, once decrease, once increase, once decrease, increase, decrease, one decrease, increase. If that's the case, then use the simple average method. Okay sir, done. Next one is super profit method. Here what you are going to do is goodwill is equal to super profit into number of years of purchase. How will you find a super profit, sir? Super profit is nothing but the profit which we are earning minus what profit is earned by the normal people in the normal rate of return. So how we can find out, sir? Profit, how much we have earned? Simple, using the average method we can find out. Minus how much is earned by the normal public, our competitors. How we are going to find out? We will find out how much capital we have invested. We will multiply it with normal rate of returns. We will get a super profit. If we multiply it with number of years of purchase, we will get it. Okay. Next one is capitalization of profit method. Here what we will do is we are going to find out how much is the maintainable profit. Okay, how much is the average maintainable profit. If we get an average maintainable profit, we will divide it by normal rate of returns. So what we will get? We will get to earn the same profit, how much capital is required. To earn the same profit, how much capital is required. For example, let us assume our maintainable profit is 10,000. Okay, normal rate of return is 10%. Okay, normal rate of return is 10%. Our capital is 75,000. Our capital is 75,000. So now 10,000, what we will do? 10,000 divided by normal rate of return we will do. That is 10,000 divided by 0.1, which will be 1 lakh. So to earn the 10,000 rupees profit, in the rate of normal rate of return, we want 1 lakh rupees capital. But actually how much we invested? We invested only 75,000 rupees. The 25,000 is there, no? The 25,000, which is the difference between normal capital employed minus actual capital employed. The difference of 25,000 is nothing but goodwill. In the super profit method, we do from here, from in the capital we do ulta. There they will be given a capital and a NRR. Here they will be given a profit and NRR. We are going to compare both the capitals. There we are going to just find out how much is the profit, both the profits. Later the difference between profits is multiplied by number of years of purchase. Next one is annuity method, which is basically looks like this. You will find out how much is the average maintainable profit and for how long you are going to maintain. You are going to use the present value factor, discounting factor, because of the inflation and all. Today's 50,000 is not equal to the 5 years 50,000, next 5 years 50,000, right? Next 5 years 50,000's purchasing power is much lesser than the current year's 50,000. So we will just discount it. How to discount, sir? 1 divided by 1 point whatever the percentage is there. If it's 12%, so it is 1 divided by 1.12, like that. You are going to find out the discount factors. Okay. Next one is adjustment regarding the capital contribution. Adjustments regarding the capital contribution. What are the adjustments? Listen, we might say after the new partner enters, we are going to set a capital base as per new partner or existing partners, and all other partners should maintain the profit in the same way. All other partners should maintain the profit in the same existing format. Then that is capital adjustment. Sometimes the existing partner might have to bring in a cash, or sometimes existing partner might have to take out the capital they have already invested because of the base. Okay. Adjustment of a life policy. See, life policy, you might say that it is a personal in nature, so it is drawings. No, here what happens is, in a firm, partnership firm itself will take the insurance on its partners, whether it might be separate life policy or a joint life policy. Later it only pays the premium. The reason is, if any partners goes in between, they need some money, no? So basically they will get a money from the insurance company. Okay, insurance, how it works, if it's surrendered in between, what you are going to get? You are going to get a surrender value. If it gets matured, for example, life insurance, how it will get matured? Once the person dies, it will get matured, no? So if it gets matured, then what we should do, sir? What insurance company will pay? Insurance company will pay the maturity amount. Now only when the admission is there, then whether life policy will mature or surrender, life policy will surrender. Okay, that life policy money, whatever we receive from that money, that we are going to give credit to our old partners, because in their balance, in their P&L we showed it as an expense, because of which their profit got reduced, right? So now they are entitled for this gain. So in the admission, JLP will be at a maturity value. Okay, that's it. Later we have saw around 7 illustrations, and we have wound up the particular chapter. Hope you enjoyed the video, and if you have enjoyed, please like, share and subscribe. Okay, bye bye.